Hello and welcome to Investors Hangout. This fortnightly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, after a stellar performance in 2021, the small cap funds are now seeing a fall. Why is this happening, and should the investors be worried about it, and how to handle your investments in such a scenario? To discuss all of this and more, we are joined by our CEO, Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
What we're seeing is that after a blockbuster 2021, the small cap funds are now falling. So why is this happening suddenly, and how should one tackle this?
One is that they are like that only. When markets fall, small caps fall more freely. But my sense is that small caps are not falling freely on a relative basis. Large caps have fallen, so have small caps, so have mid caps, and that is also visible in the multi-cap funds and things like that, or BSE 500, so to say, which is almost like a multi-cap index. And the reason is quite understandable. This particular sell-off, what is happening in the market, is primarily driven by foreign investors, and they have bigger holdings in large caps. They hold big companies, and a good amount of money which is routed in India through from them comes through the ETF. So that is basically Sensex and Nifty. So they pulling out has driven down the large caps, and small cap has not witnessed. Of course, they have fallen. In a falling market, everything falls, but they haven't fallen as much, or anything substantially more than that. So that is a great consolation. The real disappointing thing for many new investors is that investors chase performance. What they saw in 2021, people try and chase performance. That okay, this is something which is racing speedily. Let me ride it. And then so any new investor investing in equity and starting with a small cap fund and witnessing a big 10% decline, though that 10% is not a big decline compared to a large cap, but that is not a consolation. Your 100 rupee becomes 90, you feel sad, and so that is a disappointing bit, but nothing beyond that. Yes, this could be a case when you have a sustained declining phase of the market, a bear market which lingers for 2-3 years. That is a time when we actually find that investors pull out, they get away, and these small caps go completely out of favor. Whenever we have seen a big decline or a sustained decline, say the market goes down by 25-30%, they go down by 50-60%, and that is something when many investors capitulate. They see that decline and they'll get out at the end when they have lost 50%, 60%, and then they make a comeback. So small caps in those situations could be scary, and in the long run they have proved to be most rewarding, and they will remain like this. The characters are because there are strengths, so there is a case for investing in small cap. There's a risk of investing in small cap, and the risk is not with the company. The risk is with our behavior.
But in the scenario such as now, where 10% fall has been seen in small caps, should an investor exit or stay and wait for them to rise? What should an investor do in such a situation?
No, if any investor, which I understand, somebody listening to us should be investing in equity for a couple of years. So ignore this. It doesn't matter. And in fact, if anybody would have invested a year ago, he will realize that despite this fall, he is still up 25-30%, which is quite substantial. Yes, you might regret that, okay, my money went up to this much and it has come down by 10%, 15% or whatever, but I don't think it is disappointing. And equities are like this, and small caps are actually on a steroid. So they will also be like this. And I don't think this is time for people to run from this. Yes, if you are if you are losing your sleep, no investment justifies losing your sleep. Money is supposed to comfort us, not trouble us. So with that in mind, if you are getting extremely troubled by this small cap decline or the volatility or the daily ups and downs, I think that is more scary for many people who are not used to it.
And especially the new investors.
Yeah. So if you are able to reconcile with it, if you are able to live with it, if you are able to feel little desire, derive little pleasure out of it, that okay, you are a regular investor and now you'll be able to buy cheap, carry on. If you are losing your sleep, take your money out, get into a relatively more conservative equity investment, maybe get back to it with balanced advantage fund, or aggressive hybrid fund, or maybe a multi-cap, flexi-cap fund. So that will be a moderating your equity investment. That's about it. But if you are fine with it, if you are able to somehow deal with this, carry on.
All right. And what's your opinion about the passively managed funds that replicate small cap indices?
Before that, let me just put in perspective what is the case for a small cap fund and what is the case against a small cap fund, or maybe small cap stock investing. The difference between a small cap and a large cap stock is that they are relatively known name. When you are investing in Reliance or ITC or Infosys or TCS or things like that, then it's a different story. The companies. There is a comfort of scale that these companies will not disappear. These companies will not fumble. But that does not necessarily mean that they will be extremely rewarding. There have been phases in the life of these companies where for years together they haven't done well. At the same time, the thinking is that these companies cannot leapfrog. Large companies, when you have a huge operation, you really can't become a 5-time bigger company when you are at that scale. When you are a small company, you are selling goods worth 100 crore, you are making profit of 10 crore. And growing it from 100 crore to 200 crore could be very much in the realm of possibility, and that could be in the realm of possibility not only once, but for a couple of years. So the charm of that when you invest in such a company, and based on that assumption or with that expectation, and it turns out to be true, it turns out to be phenomenally rewarding. Yeah, and that is the charm. That is the draw of small cap. But then there is a pitfall. The pitfall is that when there is economic downturn, when you are faced with a declining phase, there is generally a rough weather. Interest rates are going up. People are not very excited about buying goods and services. People are losing jobs. They are not excited about spending money on the goods and services that you provide. You see a shrinkage. You see a decline. And that is something, that is a phase which for many of these companies turns out to be very devastating. For some companies, it can actually drive many of these companies completely out of business. Some companies are solid enough to withstand, and that can linger. So resilience of these companies sometimes can be tested in a declining market. But there is, my understanding is that in this changing world, where a lot of things change, our behaviors change, the way we have been ordering food and getting it. It was not possible when I was growing up, or when I was in college, or when even 5 years back. Even thinking that when Google was a small company, and then it became a way of life, the way we are watching movie. So a lot of behavior impacting thing, and small companies are able to do things well. They are nimble. They are able to make changes. They are able to adapt faster. And many a times it does not, and the rewards are outsized when you get right. So the reward, but at the same time, there are as many casualties. The mortality rate of new companies in that phase can also be high. But so that is why I think there is a strong case for having a small cap in your allocation. But you have to de-risk yourself in a multiple way. Then there are another disadvantage of investing in small cap. Small cap companies, you may not have enough information.
Yeah.
You don't know who this fellow is. When as we keep saying time and again, in the context of is choosing a stock, choosing a company, is that the person who is running the company matters most. Is he a crooked one? Will he actually treat minority shareholders the same way? Is he, excited about growth, and is he a scalable? Is he capable of running a scalable company? We keep coming across all kind of horror stories about small companies, even big companies. So small companies can completely go under the radar. So in that sense, so there are problems and there are great strengths. They can be multi-bagger and they could be a disaster. That is why I feel that and there is the information gap about small companies. So despite these pluses and minuses, I think there is a strong case for diversification. There is also a strong case for entrusting it to professional managers, because if I'm going to invest in a small company, then maybe I'll have 1 lakh rupee, 5 lakh rupee, 10 lakh rupee, and that will not get me access to the company in a manner whereby I can evaluate things logically, comprehensively, or enough input for me to decide on the company. Is it a good enough? Is it a scalable enough? Or is it a well managed company? Or so things like that. When it comes to, so you are able to spread with your 5,000 rupee, 10,000 rupee, 50,000 rupee, you are able to spread your investments over 10, 15, 20 companies, because whatever you may say, there are inherent business risks to any business. And some of these, despite your best of evaluation, will go wrong. Sometime for the company, sometime for the product, sometime for the weather, sometime for something or the other. And so some of it will work, some of it will not work. And how do you hedge against that? And basically you have to make sure that most of it works, some of it fails. And I think a fund manager is better equipped to do that, simply because they have access to it. With this advantage of scale actually matters. There is a disadvantage of fund managers that many investors will pull out money from the small caps at the inopportune time. When the money has declined, when the fund actually takes a hit by 50%, that is when investors will actually pull out. So that is a disadvantage of small cap. But otherwise I think that diversification, specialized access, evaluation, that's a huge advantage. So then coming to the real question which you're asking, that
passively managed funds,
the index, small cap index fund versus the small cap funds, actively managed fund. One is that most of the small cap index, the index itself is small, is relatively new. The indices itself, when we talk of Sensex and Nifty, they're old indices. There's a formula, there is a mechanism. Second is that these indices themselves are new. Then these funds are also new. Also, I have my worries about the small cap index, because it's unlike the large cap index. Small cap index is heavily dependent on, there will be churn from the small cap index as well. If you have a small cap index which is made up of 50 companies or 100 companies, and 10 of these stocks actually do exceedingly well, and they become mid caps, and they get ejected from the small caps. So what you are looking at, the small cap index, will be a disadvantage. And that is actually visible in the small cap index versus the small cap funds. Of course, this is not the right comparison, because even the small cap indices in small cap funds are not very old, and the small cap indices are not very mainstream. But looking at the 10-year return of the BSE small cap index versus the average of small cap fund average of return of 10 years, the difference in return is something like the index is 15% and the fund is 20%. So this looks like a 5% difference. It is not 5% difference. It is 33% more, because instead of 15, if you earn 20, it can make hell of a difference to you in a 10 years time. So the compounding, the difference, and it shows. So I would say that there is a strong case for small cap actively managed fund, but finding the great small cap fund manager remains a challenge, and it remains a question which you have to take a chance with.
All right, time now to move on to our viewers' questions, and the first one has been sent in by Rajat. He wants to understand, how does a huge AUM affect the performance of a small cap fund, and till what level is it safe to invest?
Small cap funds face a problem when they get bigger, because there's a dearth of ideas. Small cap, at the first level, there is a difference between managing a small cap fund and managing a large cap or a mid cap or a very diverse fund, simply because they are very idea intensive. When you look at a large cap fund run by one fund manager as compared to another fund manager as compared to another fund manager as compared to an index fund, the overlap of these portfolios, these four portfolios, can well be 80%, because large cap funds are supposed to invest in the top 100 companies. So if you have to choose 25 of those top 100 companies, they are likely to be 20 of those 25 companies might be the same. And the other advantage is that when you have to buy any of these companies, you don't have to worry about the liquidity. They are available in plenty. They don't have a huge impact cost when you try and buy something worth 50 crore, 100 crore, 200 crore, even in a day. That may not be the case with small cap. Small cap companies, by their very design, are sub 1,000 crore or 1,500 crore company. If you are going to buy one, but buy a meaningful position in this company, then if it is a 100 crore fund or 200 crore fund, it might be okay. Even if you take a 5% position in a 100 crore fund will amount to 5 crore rupee investment, which in many of the small cap companies will still not be possible even today. Many of the promising companies or the micro caps or the small caps are edging towards mid cap. Maybe they are there, it might be a possibility, but not underneath that. So building a position in small cap could be hard. Once you actually get bigger, then you have to look for more ideas. One is the liquidity challenge. The other is that which means that this can be dealt only by having more companies. When you have to look for more companies, it's not easy to come by, because finding and discovering a relatively poor, not so well valued or richly valued small cap, unidentified, unspotted small cap is not an easy thing. So it takes effort. You are not finding, you're not picking those 5 companies or 6 companies from the large cap index. So, and this is what we actually see here. The small cap portfolios of one fund compared to other is completely different. There might be no overlap. There might not be any overlap in their portfolio. So unlike the large cap ones where there could be 80% overlap. So looking for a company idea. So as a fund gets bigger, for the fund to actually find a position, to find an idea, a stock idea, and buy it in an impactful manner, gets harder as you get bigger, because assuming that say if there's a 100 crore fund as compared to 1000 crore fund, assuming that you have chosen or you have decided, or the fund manager thought that he will have only 25 companies to have a meaningful impact. So 25 companies, so a 4 crore position in a 100 crore fund will have adequate impact. But in a 1000 crore fund, you may not be able to build that position, and it may not be easy to sell those positions when you want to. So this is one problem. So as it gets bigger, in the mutual fund arena, there is something called winner's curse. When a small cap fund does well, and normally if you get right with 1 or 2 or 3 good positions, you do well, and then investors pour money in that. That is called a winner's curse. And when you get more money in a fund which has done well, when it was small, then the very fact that you have become bigger is a barrier to performance, because then you are, so this is the winner's curse. If you win, you are cursed, and if you don't win, then you are not being liked anyway.
Okay. Now, Arjun invested in a small cap fund few months back without understanding how risky they can be, but now he's realized his mistake. So what should he do now? Book the losses and exit, or stay on with them?
No, if he's young and if he has time, then live with it and learn it now. And as I keep it, I sound very repetitive, but nevertheless, invest regularly and use this time. And as I said that, diversifying, investing in small cap could be promising. But if you are losing your sleep, as I said earlier, that if you are actually having a very difficult time living with the declining phase of the market, or but let me tell you, Arjun, this is a phase in which small cap has fallen as much as the mid caps, and small cap has fallen little more than the large caps. So you could not have actually saved yourself from a decline in this phase. So live with it and carry on with your investments.
Pawan Jakhotia asks, how do you compare investing in mid caps versus small caps? Are mid caps better in Indian context?
To some extent, but the problems of mid caps and the problems and the challenges of mid caps and the promise of mid cap is somewhat similar to small caps, and it is also visible in the definition of the mid caps and the small caps, that mid caps can invest dominantly in mid caps and reasonably, and a good part of it can be small caps and large caps as well. Likewise for small caps, it could be dominantly in small caps, but can well be there. And this is actually a very mechanical, quantitative yardstick being prescribed by SEBI, that top 100 companies are defined as large cap, next 100 companies are mid caps, or next 200 companies, and the subsequent equity universe is small cap. So that doesn't mean that company number 151 to company number 210 They have said that this is mid cap or small cap, but that doesn't mean, the characters of those companies will remain the same. If it's small, it holds promise. If it is a great business, well managed business, and rapidly growing business. So I think, don't get into a very precise thing. The characters will remain the same. Yes, there is something which, many of these funds are able to take a shelter. When a mid cap fund actually gets very big, they tend to invest more in the larger of the mid cap, say investing in company number 101 to 125. They might be classified as mid caps, but they are almost tending to be large caps. And many a times they get into the large cap arena and then come back. So so they might have greater scalability, but nothing beyond that.
All right. Anuj Khanna wants to know if one should invest a lump sum in mid and small cap funds right now. Is it the right time, he asks?
It is never a good time to be investing money in equity per se. So investing in small cap and mid cap, not. But yes, if at some point you come across a situation, if one that you should have a stomach for that. If you are faced with a situation that, okay, you find these companies, the underlying companies of a fund to be excellent, you know the names, you find them but markets go crazy sometimes. I don't think, there was, if somebody has the courage and belief, and you are faced with the situation that, okay, the fund has gone down in value by 40%, and if you have money, then by all means, but it's very important to have that, you should have the courage, and you should have the money, and then only you should do it. Otherwise, right now, I don't see the complexion of the market is not something which makes it very compelling, that, okay, you are getting tempted to somehow, somehow organize money to invest in it. No.
Naveen Kaura says market is extremely volatile right now. So how should an investor handle the situation?
Deal with it. Markets are volatile now, and they were volatile before, and they will be volatile in future. It is like that only. So learn with it. And I think, if you have these 2, 3, 4 things nicely in place, it will help you deal with it. Which is, if you have an emergency fund, which means you are not dependent on the market for anything short term. Then if your basics are taken care of, life insurance, health insurance, and the money that you are investing is not needed for 5 years or more. And if you are a regular investor, because market volatility can be turned into an advantage for yourself. If you are a regular investor, then you normally feel happy when the market goes down, because you are buying cheaper. So if you have these 3, 4 ways to configure your behavior, you will feel happy. And unfortunately, markets will remain volatile. And in fact, markets will become even more volatile, because we are, in the last 5, 7 years, 10 years, I have seen that there is an increasing trend. Not only that the companies change more rapidly, or we are more connected, or we are in a more globalized marketplace, and you can buy anything from anywhere, and you don't know what is going to, so obsolescence, think companies become obsolete or more serviceable, or the technological changes, things like that. Many things changing, but more importantly, the markets have become even more volatile, or the integration of the market, foreign investors putting money and pulling money out. But more importantly, the impact of the media consumption, the scale of media, that is actually making us behave in a different manner. It is having an impact on our behavior. We get very disappointed very quickly, or we get very pessimistic very quickly, and we get optimistic very quickly. So that actually shows in our behavior. And that, I think, because 20 years back, when I wrote, when I was writing the edit of Mutual Fund Insight, when we got started, it was the second or third editorial of the magazine. I was talking about, the CNBC TV channel, and I was mostly, in value research, I had put an embargo on not watching TV during lunchtime, because everybody was, getting tempted to watch CNBC, because I thought that, this is just this is a distraction. A lot of people have this, poor notion of being an insider by watching CNBC. It is nice for advice and general things or for information, but I think, the moment you get to see that news, in fact, all the news that you see on CNBC cannot be on news on CNBC before it is there on the stock exchange's website. That is a law of the land. A company can reveal something meaningful first on the stock exchange, and then only it can appear anywhere else. So in that sense, I always thought so. And then I thought that CNBC is a huge distraction. When I look at it now, CNBC looks like an ancient time, hardly, the amount of social media that we're witnessing, or the amount of data available on the number of websites, the number of Telegram groups, the way, and a lot of these things are underground, they're not visible, and everybody is in his own community, and it is so overpowering. So, markets will become even more volatile as a result of all this.
Well, Naveen, I hope you've got your answer, but I would say that you must watch our previous episode of Investors Hangout for a more elaborate explanation. Do watch our March 11th episode. Now, today's last question has been sent in by Surekha. She asks, are monthly dividends a profitable way in comparison to SWP for generating regular income?
If you don't pay taxes, and these monthly dividends will also not matter, will not add up to your income that you become taxable, then it doesn't matter. Either of them are the same. Otherwise, SWP might be a better way, simply because you are able to structure a withdrawal plan based on your needs, and you can also customize it. You can also change it over a period of time depending on your investment performance. Assuming that you choose to withdraw 8% of your capital, and if your fund or your investment has generated 12%, you can increase it, or you will create a buffer for yourself. If it turns out to be disappointing, you expected 8%, and that is how you actually plan to withdraw, and your investment returned only 6%. So next year you will be able to revise after 12 months that, okay, let it be lower, because you don't want to eat your capital. So you will have greater flexibility. And dividends will come at their own time when the fund company chooses to pay you the dividend. So you will have greater flexibility, and you're getting money at timing of your choice, and scale is better with SWP.
Well, with that, it's a wrap on this episode. Thank you, Dhirendra.
Thank you.
Thank you to all our viewers. Do keep sending us your questions and keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Thanks for watching. Bye for now.